You are welcome to my channel. Today we are going to look at double entry principle. So basically today we are looking at the golden rule in double entry. When it comes to double entry, what do you know by double entry? So we have a golden rule. And the golden rule says that to every debit transaction, we have a credit transaction. To every debit transaction, we have a credit transaction. That means, let me say for the purchase of this marker, I go to the business, a bookshop, and I want to buy a marker. I'll open up the marker's account and I'll also open up a cash account. That means the marker and the cash account. Therefore, when someone's losing the marker, he's going to receive cash. And now, for us, we are losing the cash, but we're receiving a marker. That means it will be like this: cash and marker. And we put our amount. So, the purchase of a marker means we are receiving a marker but using cash, and also here we are losing cash to purchase a marker. So every transaction, every debit transaction has a corresponding credit transaction as well. So that's what double entry is all about. It talks about the duality when it comes to the transactions of the business. That means every transaction that happens in the business must have a corresponding entry. Now, this is what makes the accounting equation to balance. So we are looking at how the accounting equation remains stable and balanced, so that at the end of the day, we can tell of the profitability of the business and the performance of the business. Therefore, if you receive money, you debit it, and if you're taking out money, you credit it. So we have two words here. One is the debit, and the other is the credit. What does it mean to debit? For example, because these are terms we are going to be using and the terms that we are going to be seeing. Debit means receiving or reception. For example, if money is coming into the business, we are receiving money, we debit. Then credit means giving out. So this means in case we are purchasing something, we are going to lose money to the suppliers or to the person from whom we are purchasing the items. Therefore, when you say we credit, it means we are giving out. When we say we are debiting, it means we are receiving an amount of money. Therefore, in an account, this is how an account is. Therefore, we shall have our title. It is always in the T form. Then the left side of the account is what we call the debit side. Then the right hand side of the account is what we call the credit side. Therefore, we record things that are coming into the business on the left side of the account, and the things that are leaving the business on the right side of the account. So our account is going to be in a T format, and this is what we shall have. Now the debit side, sometimes they put a DR. This represents debit and this represents credit. A fundamental question comes in: what is an account? What is an account? An account is a page of a ledger. And therefore, we are going to see how we record our transactions into the page of a ledger. You know, when you see some ledgers, a ledger is always in this form. So this one creates an account, like I've told you here. So it has a title, it has a debit side, and it has a credit side. So let us look at an account. So we have basically two types of accounts. We're going to look at the classes of accounts. But for now, let us first see. We have personal accounts, and we have impersonal accounts. What are personal accounts? Personal accounts, these are accounts that record persons. How? They record names of people. Let's say Emmanuel account. Let us say Jonah account. And basically they record debtors and creditors of the business. That means, for example, they say in a business, we got goods on credit from Jonah. Therefore, we are going to classify Jonah account as a personal account. We record that in the person's account. That means Jonah account is a personal account. So, personal accounts, basically, they record debtors and creditors of the business. So, if we buy goods on credit and they are being got from a certain individual, say Emmanuel, we shall open up Emmanuel account. Then, in personal accounts, basically, these are accounts that, of course, they record properties. That means we are going to say in personal accounts, these are accounts that record properties. Now, we have still, we can divide the properties into two. We have the tangible properties and we have the intangible properties. Now, we have the tangible properties and we have the intangible properties. For example, when you talk about the tangible properties, we can say a motor vehicle. We open up a motor vehicle account. So we have things like motor vehicle, we have things like, we can talk about furniture. We can open up all those accounts as long as something is tangible and has physical existence. So these ones are tangible properties, but we also have the intangible properties. For example, let's talk about salary. When you say he paid salary, of course he paid salary by cash. You can see the cash, but you cannot see the salary. Therefore, salary is an imaginary word. Therefore, it means salary is intangible. It cannot be seen. It has no physical existence. Therefore, we shall see the cash, but we cannot see the salary. For example, again, let us say he paid rent. We can see the cash by which we are paying rent with, but we cannot see the rent, which means rent too, it is an intangible property. Now, tangible properties here, their accounts are called real accounts. And the intangible properties, their accounts are called nominal accounts. So, I had to derive it from where it starts from to bring us to the two accounts from which I wanted to talk about. Now, the classes of accounts are three. We have three classes of accounts. We have the personal accounts, which record the debtors and the creditors of the business. And these people, we record them with their names. For example, Emmanuel account, Jonah account, Joshua account, any other account of a person. Then we have, now the impersonal accounts here, we have real accounts and nominal accounts. Real accounts record tangible properties, whereas nominal accounts record intangible properties. So this is what we like to talk about today. Therefore, when we talk about our classes of accounts, we have personal accounts and we have real accounts and we have nominal accounts. So these are the three accounts that we have, and we are going to be posting based on these three accounts. Now, these are the rules that we are going to be using when it comes to the double entry principle. Double entry principle, you debit what's coming in and credit what's going out. You debit what's coming in and you credit what's going out. Then you also credit, you debit the expenses and you credit the incomes and gains. You debit, it is like this. You debit expenses and credit incomes and gains. Now, I would like to talk about this. For example, we have been talking about that when money is coming to the business, we debit. And when money is going out of the business, we credit. But for this scenario, we are talking about debiting expenses and crediting incomes. How does this come about? Let me say, for example, we have rent as our expense. Rent. We are paying rent worth 1,000 shillings by cash. That means we are going to open up two accounts. One is the rate account. Rate account. Then also we are going to open up the cash account. So remember, we have said that we are paying rent worth 1,000 by cash. That means we are losing cash worth 1,000. Therefore, you come to the cash account and you say, we are losing 1,000 shillings to rent worth 1,000. So that means we have already entered on the credit side. So that means we must have a corresponding entry on the debit side. So you cannot enter on the same side. Let me say credit. You cannot do that. That means if you enter on the credit side, when you come on the rate account, you're supposed to record on the debit side. What does this mean? We are paying cash for rent worth 1,000. When you come to the rate account is receiving cash worth 1,000. Now, rent is an expense and we are debiting it. That means we debit expenses and credit incomes and gains. Now, the same thing happens to the incomes and the gains. It's the same thing that happens. So that means as we do this, we need to keep in mind how we are going to operate, especially under the different circumstances. Now, when you meet an expense is debited. An income or a gain is credited. So the same thing happens to that as well. For example, I would have given you an example of a sale. Okay, let us do it as well. So, imagine we make sales. Sales is an income, is a gain. So if we make sales worth 2,000 shillings, we are going, and these are cash, by cash. We are going to still open up two accounts. One is the sales account, and the other is the cash account. So we have cash account, and we have the sales account. So, if this is what we do, so we have sales worth 2,000 by cash. That means we are receiving this. So when you come to the cash account, you say we are receiving cash from sales worth 2,000. Now, when you come to the sales account, we are going to credit, and we shall say cash worth 2,000. So this means actually we had to release sales worth 2,000 shillings. Here it means we received cash from the sales worth 2,000. So That's how the double entry principle works. That if we credit, every transaction has a credit and has a debit. Every transaction that happens in the business must have a credit and debit transaction. So this is how our accounts are done, and later on we balance off the accounts, like we shall see in our next video. We shall see how we can balance off the accounts and come up with the balances, balance carried down and balance brought down. Thank you so much for today. This is Kevin Davis Accounting. Thank you for tuning in. Subscribe, like, and share.